Every 4 years, the amount of new Bitcoin created gets cut in half. Every single time this has happened in history, Bitcoin's price has reached new all-time highs within 18 months. This event is called the halving, and AI has analyzed every cycle to tell us what the pattern suggests for what comes next. Understanding the halving is understanding the most important supply-side dynamic in all of crypto. Let me explain it in plain English. To truly understand the halving, we first need to look at the engine that powers the entire Bitcoin network: mining. At its core, Bitcoin is a decentralized digital ledger, a global record of every transaction ever made. But who maintains this ledger? Who ensures that all transactions are valid, and that no one is spending the same digital money twice? This crucial role is filled by Bitcoin miners. These aren't individuals with pickaxes, but rather a global network of powerful specialized computers known as ASICs. They perform an incredibly important job. They gather up recent transactions into bundles called blocks. To add a new block to the permanent chain, miners must compete to solve an extremely complex mathematical puzzle. This process is called proof of work. It requires an immense amount of computational energy, which is precisely what makes the network so secure. The first miner to solve the puzzle gets to add their block to the blockchain, and, in return for their effort and expense, they receive a reward. This reward is the primary incentive for miners to participate and act honestly. It consists of two parts: the transaction fees paid by people sending Bitcoin, and a much larger, more significant component known as the block subsidy. This subsidy is the creation of brand new Bitcoin, minted out of thin air. It's the only way new coins enter the ecosystem, a carefully controlled issuance schedule written into Bitcoin's original code by its anonymous creator, Satoshi Nakamoto. And this is where the halving comes in. The halving is a mandatory, automated event hard-coded into Bitcoin's protocol. It dictates that after every 210,000 blocks are mined, the block subsidy is cut exactly in half. Since a new block is added to the blockchain approximately every 10 minutes, this milestone occurs roughly every 4 years. This process is designed to be predictable and unchangeable, creating a system of digital scarcity. When Bitcoin first launched, the reward was 50 Bitcoin per block. After the first halving in 2012, it dropped to 25. In 2016, it fell to 12.5. And, in 2020, it was halved again to 6.25 Bitcoin. That brings us to today. For the past 4 years, miners have been receiving 6.25 newly minted Bitcoin for every block they successfully add to the chain. At the next halving, which occurs at block number 840,000, that reward will be cut in half once more. Miners will then only receive 3.125 Bitcoin per block. This halving cycle will continue every 4 years until the block reward becomes infinitesimally small and the final Bitcoin is mined, sometime around the year 2140. At that point, the total supply will be capped forever at just under 21 million coins. The halving is the mechanism that ensures this finite supply. It systematically reduces the rate of new supply entering the market. So, while the flow of new Bitcoin gets cut in half every 4 years, the demand for it can stay the same, or, as history has shown, continue to grow as more people learn about it and adopt it. This creates a fascinating economic dynamic. It's a textbook lesson in supply and demand. When you have a predictable, programmatic reduction in the supply of an asset, and demand for that asset remains steady or increases, the laws of economics suggest that its price will face upward pressure. This predictable scarcity shock is what makes the halving one of the most watched and anticipated events in the entire crypto industry. To understand where we might be going, it's essential to look at where we've been. While past performance is never a guarantee of future results, Bitcoin's post-halving history reveals a compelling and consistent pattern. By examining these cycles, we can gain valuable context for the market dynamics we see today. Each cycle tells a story of supply shock, demand growth, and eventual market maturation. Let's break down the 3 previous halvings to see what lessons they hold. Our story begins with the very first halving on November 28, 2012. At this point, Bitcoin was still a niche asset, largely unknown to the general public. The block reward was cut from 50 to 25 BTC. The price at the time of the halving was just around $11. What followed was nothing short of explosive. Over the next 12 months, the price surged to a peak of over $1,100. That's a staggering 10,000% increase, a true 100x return for early adopters. However, what goes up that fast often comes down hard. After this incredible peak, Bitcoin entered a prolonged bear market, eventually seeing its price fall by over 80% from its all-time high. This first cycle established the core pattern: a supply cut, a delayed but powerful price rally, a euphoric peak, and a significant correction. 4 years later, the second halving occurred on July 9, 2016, cutting the reward to 12.5 BTC. By now, Bitcoin had gained more recognition. The price on halving day was approximately $650. The market didn't react overnight. It took time for the supply squeeze to take effect. But then, the bull run began. This cycle was longer, taking about 18 months to reach its zenith. In December 2017, Bitcoin famously peaked at nearly $20,000, capturing mainstream media attention worldwide. The percentage gain was smaller than the first cycle, around 3,000%, but the absolute value created was immense. And just like before, this peak was followed by the infamous crypto winter of 2018, which saw another painful drawdown of over 80%. This brings us to the most recent halving on May 11, 2020. The reward dropped to 6.25 BTC per block, and the price was hovering around $8,700. This cycle was different. It occurred amidst global economic uncertainty and saw the arrival of significant institutional investment. Big corporations started adding Bitcoin to their balance sheets. Again, the cycle took roughly 18 months to play out, culminating in an all-time high of about $69,000 in November 2021. The percentage gain from the halving price was approximately 700%, a much smaller multiplier, but on a much larger base. The subsequent bear market was also less severe than previous cycles, with a drawdown closer to 75%. So what's the key takeaway from this history lesson? A clear pattern emerges. Each halving has been followed by a new all-time high, typically within 12 to 18 months. However, as the market grows, the law of large numbers kicks in. Each cycle's percentage gain shrinks, and the corrections, while still severe, have become slightly less dramatic. The market is maturing, moving from pure retail speculation to a more established asset class with institutional players. The direction has been consistent, but the magnitude of the swings is diminishing. So, with history as our guide and an understanding of the current market forces, can we predict the future? Not with certainty, but we can leverage powerful tools to model potential outcomes. We turn to advanced artificial intelligence, feeding it decades of data, to get a glimpse of what might lie ahead. These aren't simple trend lines, these are sophisticated models trained on every piece of relevant information we could find, every historical halving cycle, every price fluctuation, vast archives of on-chain data like transaction volumes and wallet activity, and a full spectrum of macroeconomic indicators, from interest rates and inflation reports to global liquidity metrics. The AI even ingested sentiment analysis from news and social media to weigh the human factor. Its task was to synthesize this ocean of data and project a range of scenarios for the post-halving market. After processing all these variables, the AI generated a base case scenario. This is the path it considers most probable, assuming current trends continue without major unexpected shocks. In this model, the next cycle is projected to deliver gains, but with the expected pattern of diminishing returns. Instead of the 10x or higher multiples seen in Bitcoin's youth, the AI suggests a more mature asset delivering a 2x to 5x return from its pre-halving price level. This scenario reflects a market that is larger, more integrated into the global financial system, and therefore less prone to the explosive, volatile growth of its early days. It anticipates a steady, but not spectacular increase in demand from both retail and institutional players, balanced by a neutral, macroeconomic environment. But what if conditions change? The AI also modeled for that. In a more conservative scenario, persistent high interest rates could keep investors away from risk assets like crypto. A severe global recession or a coordinated regulatory crackdown in major economies could create significant headwinds, leading to a much flatter cycle, perhaps struggling to even double in value. On the other hand, An optimistic scenario exists where the stars align perfectly. Imagine a rapid pivot to lower interest rates by central banks, a surge of capital from the new spot ETFs that far exceeds expectations, and a breakout in Bitcoin's utility through Layer 2 solutions. In that world, the AI suggests the cycle could outperform the base case, potentially pushing past that 5x marker. The most crucial output from the AI wasn't a single number, but the concept of an uncertainty band. It shows that the further we look into the future, the wider the range of possible outcomes becomes. These models are tools for strategic thinking, not crystal balls. They help us understand the key variables: macro interest rates, the regulatory environment, and the pace of institutional adoption, and how they can dramatically alter the outcome. Therefore, it's essential to treat these projections as what they are: data-driven possibilities, not guarantees. Don't bet everything on any single cycle prediction, no matter how sophisticated the source. The wisest approach is to use this information to build a robust strategy that can succeed across a range of potential futures. The best way to position for a halving cycle, per AI analysis, is systematic DCA that accelerates slightly in the 6 months before and after the event. Swan Bitcoin has a platform designed specifically for this, link in description. Subscribe and tell me, did you invest in the last halving cycle?